Hi guys and welcome back to the Mindful Investing channel. Today I want to value Microsoft, ticker MSFT, with you. As always, we will value Microsoft using our simple discounted cash flow model. To be able to value Microsoft using this simple DCF, we have to first make a couple of assumptions. First, we have to assume Microsoft's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Then we have to assume Microsoft's price to free cash flow multiple at the end of our holding period, so basically in 10 years. And lastly, we have to assume Microsoft's buyback yield over our holding period. So let's begin with our assumptions for Microsoft's free cash flow growth rates. Personally, I like to base my free cash flow growth rate assumptions on Microsoft's historical free cash flow growth rates. When we calculate Microsoft's compound annual growth rate for its free cash flows based on the last 4 years, we come up with an annual growth rate of roughly 15.6%. Because I want to be conservative in my assumptions, I only assumed a free cash flow growth rate for the next 5 years of 12% and for the 5 years following those 5 years of 8%. Next, we have to assume Microsoft's price to free cash flow multiple at the end of a holding period, so basically in 10 years. Because Microsoft is a high quality company with a high percentage of recurring revenues, and to reflect the 8% free cash flow growth rate I assumed for the last 5 years, I assumed a price to free cash flow multiple at the end of a holding period of 20. Next, we have to assume Microsoft's annual buyback yield over a holding period. Like with our growth rate assumptions, I personally like to base my buyback yield assumptions on Microsoft's historical buyback yield. When we calculate Microsoft's annual buyback yield based on the last 5 years, we come up with an annual buyback yield of roughly 1%. Because I think that my free cash flow growth rate assumptions are already quite conservative, I also assumed an annual buyback yield of 1% for the next 10 years. Because we calculated Microsoft's free cash flows to the whole company, which is usually funded by debt and equity, which bear different costs, we have to reflect those cost differences in our discount rate. To do so in our simplified DCF, we simply enter Microsoft's current market cap, its interest-bearing debt, and its interest expenses. Now we can finally calculate our IRR, or basically our annual rate of return, by simply adjusting our cost of equity until the number in the green box is equal to Microsoft's current enterprise value per share. When we do so, we come up with an expected annual rate of return based on our assumptions of roughly 9.4%. So that's it for today's video about Microsoft. Please feel free to ask any questions in the comment section and leave a like if you enjoyed the video. Please always remember to do your own due diligence, your own research, and never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.